trade that damages you most is not always the one that loses money. It is often the one that teaches you the wrong lesson because it worked. You broke your rule, added too late, moved your stop, ignored the character of the market, and the position still paid you. That kind of profit is expensive. It quietly trains the mind to believe that discipline is optional when conviction feels strong enough. This is one of the hidden costs of trading. The market does not correct every mistake immediately. Sometimes it rewards impatience, flatters stubbornness, and disguises luck as skill. A trader can survive for a season on poor habits if conditions are generous. But over years, the account begins to reflect what the trader repeats, not what he occasionally understands. To last in speculation, you need more than courage, intelligence, or the ability to read a chart. Those qualities may get you into trades, but they will not keep you from ruining yourself when your judgment is tired, when the tape is fast, or when a recent win has made you careless. The habits that matter most are often invisible because they happen before the order is placed. They live in the pause before entry, the restraint after a profit, the refusal to trade when the market is not speaking clearly. Watch your own behavior around uncertainty. Do you become more active when you should become more selective? Do you search for confirmation after you already know the trade is weak? Do you confuse movement with opportunity simply because standing aside feels like falling behind? These are not small details. They are the quiet mechanisms by which a trader turns a manageable decision into an emotional debt. The market has a way of exposing every private weakness, but it does not do it all at once. It waits until size increases, until confidence rises, until the trader begins to believe that recent results have changed the rules. Then the same small habits that seemed harmless begin to carry real weight. A late entry becomes a chase. A wider stop becomes an excuse. A missed exit becomes a hope. Cause and effect may be delayed, but it is not cancelled. This is why lasting success depends on habits that do not look impressive from the outside. The ability to wait without feeling idle. The willingness to cut a position without negotiating with it. The discipline to increase size only when the market confirms, not when the ego demands recognition. The skill to observe price without needing to predict every movement. These are not dramatic acts, but they decide whether a trader is building judgment or merely collecting experiences. So before studying entries, patterns, or larger profits, look at what your routine is teaching you. Notice what you do after a loss, after a win, and after doing nothing for several days. Notice whether your decisions become cleaner when the market is quiet, or whether boredom begins to invent trades. A trader's future is often hidden in those ordinary moments, long before the balance sheet announces it. And that is where the deeper lesson begins, not in the trade itself, but in the unseen habits that decide whether the trader is prepared to handle what the market gives next. A winning trade can leave a mark on you that is harder to see than the mark left by a loss. After a loss, you may feel pain, doubt, or caution. Those feelings are obvious, but after a profit, the danger often comes dressed as clarity. The mind begins to say, I saw that well. I understood it. I should act with more force next time. That is where a trader must become careful, because the market has not certified your judgment simply because one trade paid you. Profit has a strange power. It can make a man believe that his process was sound, even when only the outcome was favorable. You may have entered late, ignored hesitation in the price, or taken a position for reasons you would not defend in a quiet review. Yet if the trade works, the mistake does not feel like a mistake. It feels like instinct, and once a mistake is rewarded, it becomes easier to repeat. That is how carelessness enters, not through ignorance, but through success that was not properly examined. This is why emotional neutrality, after being right, is one of the invisible habits of a durable trader. It is not coldness. It is not refusing to enjoy success. It is the discipline of not allowing a winning result to inflate the meaning of your opinion. The market gives money for many reasons. Sometimes it gives because your read was correct. Sometimes it gives because the broader tide carried you. Sometimes it gives because other traders were forced to move in the same direction for a short while. If you treat every profit as proof of superior judgment, you begin building confidence on ground you have not tested. Notice what happens after a clean win. Do you become quicker to believe the next idea? Do you look at a weaker setup and give it the respect of the stronger one that came before it? Do you feel annoyed when the market slows down, as if it owes you another opportunity? These reactions matter because they reveal whether profit has sharpened you or softened you. A trader who cannot return to neutral after being right starts to trade from memory. He remembers the feeling of the last win and carries it into a different market moment. That is a dangerous transfer. The next trade does not care that the previous one was profitable. It does not inherit the same conditions. It does not owe you continuity. When you allow the emotional residue of a win to guide the next decision, you are no longer reading the market as it stands. You are reading it through the glow of recent approval. Cause and effect becomes distorted. You take a trade not because the evidence is clear, but because your confidence is still warm. The practical habit is simple, but not easy. After a winning trade, pause long enough to separate the result from the behavior that produced it. Ask yourself what you did well, what the market actually confirmed, and where fortune may have helped. Do not punish yourself for profit, but do not worship it either. A winning trade should be studied with the same sobriety as a losing one, because both can mislead you if you only look at the money. You must also watch the speed of your next decision. The first trade after a meaningful win is often a test of character. If you find yourself wanting to enter faster, speak with greater certainty, or dismiss small warnings, then the profit has begun to influence you. Step back. Let the market present a fresh reason. A serious trader does not spend yesterday's correctness as credit for today's risk. This habit builds restraint where most traders become loose. It keeps the mind from turning one good decision into a license for several careless ones. It teaches you to respect the market as a new problem each time, not as a continuation of your last success. And once you can return to neutral after being right, the next challenge is even more precise. Learning to act only when the market has reached the place where action is truly justified. A trade can be correct in direction and still be wrong in execution. You may see the move before others see it. You may understand the pressure building in the price, but if you enter before the market reaches the point where the decision is justified, you have not acted with discipline. You have acted on possibility, and possibility by itself is not a trading signal. This is where many good ideas are damaged. The trader studies the market, marks the level, recognizes the condition, and then steps in too soon. Price has not confirmed. The level has not been tested. The movement has not shown whether buyers or sellers are truly in control. Yet the order is placed because the trader wants to be early. He thinks being early gives him advantage, but often it only gives him more time to doubt the position. There is a difference between preparation and execution. Preparation allows you to say, if price comes here and behaves this way, I will act. Execution begins only when that condition appears. When you confuse the two, you turn planning into prediction. You stop waiting for the market to prove something and start asking it to reward your imagination. The result is usually a position entered at a poor location, with unclear pressure, and no clean reason to stay if the trade hesitates. A proper decision point is not just a price. It is a place where the market must reveal something. It may reveal strength by holding a level. It may reveal weakness by failing to reclaim one. It may show acceptance, rejection, continuation, or exhaustion. The point matters because it reduces argument. Before price reaches it, nearly everything is opinion. At the decision point, behavior begins to separate strong ideas from weak ones. This is why execution requires patience of a very practical kind. It is not passive waiting. It is active observation. You are watching whether the market comes to your area with force or fatigue. You are watching how it reacts when it gets there. You are watching whether the trade still has the same reason it had when you first planned it. If the reason disappears before the entry appears, then there is no trade. A missed trade is not the same as a failed trade. When you enter too early, you lose more than a better price. You lose clarity. Every small movement starts to feel important because your position is already exposed. A normal pullback feels like a warning. A pause feels like rejection. A small shake becomes difficult to interpret because you did not wait for the market to define the situation first. Poor timing creates confusion, and confusion leads to unnecessary adjustment. The practical habit is to name the decision point before the trade is live, not vaguely, not somewhere around here. You should know what price must do, what behavior you need to see, and what would make the idea invalid before entry. This does not mean the trade will work. It means your action will have a reason that can be examined later. Without that, you are not building execution skill. You are only collecting outcomes. You must also learn to respect the trade that never triggers. If the market moves without reaching your place, let it move. If it gives the level but not the behavior, let it pass. The purpose of execution is not to participate in every movement. It is to participate only when the market reaches the place where your risk has structure and your decision has evidence. Over time, this habit changes the quality of your trading. You stop chasing the first sign of movement. You stop treating every idea as urgent. You begin to understand that the market offers many invitations, but only a few decisions. And once you learn to wait for the decision point, the next question becomes unavoidable. Before any trade is taken, what cost are you truly prepared to accept? A trader can be right often enough to feel intelligent and still be losing money in a quiet, mathematical way. That is one of the hardest truths to accept because the mind prefers to count wins. It remembers the trades that prove the idea correct. It likes the comfort of a high winning percentage. But the account does not care how often you were right if the few times you were wrong carried too much weight. The first number a serious trader must respect is not the possible profit. It is the possible loss. Before the market can reward you, it can test you. Before a position can grow, it can move against you. If the size of that adverse movement is not known and accepted before entry, the trade has no real boundary. And a trade without a boundary is not a business decision. It is an open invitation for arithmetic to turn against you. This is where traders misunderstand skill. They believe the question is, how much can I make if I am right? But the better question is, how little can I lose if I am wrong? The first question feeds desire. The second protects the trader from ruin. A profitable method can survive ordinary losses, but it cannot survive losses that expand beyond their intended size. Once the average loss begins to grow faster than the average win, even good entries lose their value. The market does not need to defeat you on every trade. It only needs you to allow 1 or 2 losses to erase the work of many correct decisions. Suppose a trader takes several clean profits, each modest and controlled. Then one position moves against him, and he allows it to become 2, 3, or 4 times the size of a normal loss. The damage is not only financial. It changes the entire equation. Now the next trades are no longer working to build capital. They are working to repair an avoidable hole. This is why loss size must be treated as a fixed business cost, not as a flexible opinion. Every trade carries an admission price. You pay that price for the chance to participate. But if you keep increasing the price after the trade begins, the business becomes impossible to measure. You can no longer know whether your method has an edge, because the cost of being wrong is unstable. A system with unstable losses cannot be judged clearly. Winning percentage alone can deceive you. A trader who wins 7 times out of 10 may still fail if the 3 losses are too large. Another trader may win less often but prosper because the losses are contained and the gains have room to matter. The difference is not drama. It is ratio. Average win, average loss, and frequency work together. If one part is ignored, the others cannot save you for long. You should know your numbers in plain terms. How much do you normally lose when wrong? How much do you normally make when right? How often does each happen over a meaningful sample? Do not answer from memory. Memory favors comfort. Records show the truth. If your losses are irregular and your wins are ordinary, the weakness is already visible. If your largest losses appear after you were unwilling to accept a normal one, the arithmetic is warning you before the market does. The practical habit is to judge a trade from the loss side first. Before you consider the target, the story, or the attraction of the setup, Define the amount that proves the attempt too costly. Then ask whether the potential reward is large enough to justify that cost. If it is not, the trade may still move in your favor, but it does not deserve your capital. Opportunity without proper proportion is only temptation with a better name. This habit gives your trading a measurable foundation. It prevents one opinion from becoming too expensive. It keeps your future trades from carrying the burden of one uncontrolled decision. And once the cost of being wrong is brought under control, the next discipline is to understand why the same trade idea can have very different odds depending on the character of the market around it. The same setup can look wise in one market and foolish in another. A breakout, a pullback, a failure, a retest. None of these things carry fixed meaning by themselves. They borrow their meaning from the condition around them. If you study the signal without studying the market it appears in, you may be reading a single word while ignoring the sentence. Price does not move in a vacuum. It moves through phases. Sometimes the market is advancing with broad participation and weakness is quickly absorbed. Sometimes it is tired, stretched, and rising only because the last sellers have stepped aside for the moment. Sometimes it is locked in a range, where strength near the top invites selling and weakness near the bottom invites buying. The pattern may look familiar, but the pressure behind it is not the same. This is why a trader must read conditions before reading setups. A setup is only a proposal. Market structure tells you whether that proposal deserves attention. If the market is trending cleanly, a continuation pattern may carry authority because participants are already committed in one direction. But in a choppy market, the same pattern may only be bait for traders who expect movement where there is only rotation. The chart can show the same shape while the market is telling a different story. You must learn to ask what kind of market you are standing in. Is price expanding or compressing? Are advances holding, or are they being sold quickly? Are declines breaking structure, or are they being absorbed? Is volume confirming movement, or does activity disappear at the important places? These observations are not decoration. They tell you whether the market is organized or confused, whether pressure is building or fading, whether the crowd is acting with conviction or simply reacting to noise. When conditions are ignored, traders begin to blame the setup. They say the pattern failed, the signal was false, or the market was unfair. But often the failure began earlier. The trader gave authority to a signal that had no support from the environment. He treated a range like a trend. He treated exhaustion like strength. He treated volatility like opportunity. Cause and effect was already in motion before the entry was ever considered. A strong market behaves differently from a weak one. In a strong market, bad news may be absorbed, pullbacks may stay shallow, and late sellers may be forced to cover. In a weak market, good news may produce only brief rallies, support may fail without much warning, and buyers may hesitate where they once defended price. These differences matter because they reveal the character of participation. The market is always showing you whether traders are eager, cautious, trapped, or retreating. Do not rush to name a setup before naming the condition. A clean pattern inside a poor environment is not the same as a clean pattern inside a supportive one. The first may require suspicion. The second may deserve focus. This habit keeps you from treating every chart formation as equal. It teaches you to weigh the background before respecting the signal. The practical work is to begin each session with a simple reading of behavior. Where has price been accepted? Where has it been rejected? Are buyers gaining ground, or merely delaying decline? Are sellers pressing, or only disturbing an advance? The answers will not predict every movement, but they will keep you aligned with the market's present character. That alignment is valuable because it prevents you from forcing trades into conditions that cannot support them. Over time, this habit changes what you notice first. You stop asking, "Is there a setup?" and begin asking, "What kind of market would make this setup meaningful?" That question alone removes many weak trades before they can tempt you. But once the market's character is understood, another discipline becomes necessary, deciding in advance what matters before speed and pressure begin to narrow your judgment. The worst trading decisions are rarely made because the trader knows nothing. More often, they are made because he is trying to decide too much while the market is moving too fast. The price begins to run, the spread widens, the candle stretches, the account flashes, and suddenly the mind is asked to choose direction, size, entry, exit risk, and reason all at once. Under that pressure, intelligence does not disappear, but it becomes crowded. A calm mind can handle complexity before the trade. A pressured mind cannot handle it during the trade. This is why serious decision-making begins long before action is required. You reduce choices in advance so that, when the moment comes, you are not debating every possibility. You are only checking whether the market has met the conditions you already decided were important. This is not rigidity. It is protection against confusion. The market creates motion, and motion creates urgency. Urgency makes weak choices feel necessary. If you have not already defined what matters, everything begins to look important. A fast move looks like proof. A small hesitation looks like danger. A sudden reversal looks like a command to act. Without a decision map, the trader becomes available to every tick. The mistake is believing you will become clearer once the trade becomes urgent. Usually the opposite happens. Pressure narrows attention. It makes the nearest movement seem more important than the larger plan. It makes the trader react to what is loud instead of what is meaningful. When this happens, decisions are no longer made from judgment. They are made from interruption. A trader must know, before the market accelerates, what evidence is required. What condition must be present? What would cancel the idea? What action is allowed if price moves quickly? What action is not allowed, no matter how tempting it feels? These questions are not meant to predict the future. They are meant to prevent negotiation at the worst possible time. When the market is calm, you can think. When the market is violent, you should already know what thinking produced. Reducing choices also prevents the trader from changing identity in the middle of a move. One moment he is waiting for confirmation. The next moment he is chasing strength. One moment he says risk must be contained. The next moment he says the opportunity is too good to miss. This kind of shifting does not feel reckless while it is happening. It feels responsive. But if each new movement changes the rules, then the trader has no rules. He only has reactions with explanations attached afterward. The practical discipline is to separate allowed decisions from forbidden decisions. You may decide that if price reaches a certain area and confirms, you can act. You may decide that if price runs without you, you cannot chase it. You may decide that if the market becomes disorderly, you step aside rather than widen your interpretation. These limits do not weaken you. They spare you from becoming creative under stress, which is when creativity often becomes an excuse. You should also simplify the number of outcomes you are willing to trade. Before the session begins, there may be 10 things that could happen, but only 2 or 3 may deserve your involvement. The rest are observations, not invitations. This distinction is important. A trader does not need a response for every movement. He needs a prepared response for the few movements that match his work. When choices are reduced in advance, discipline becomes less dependent on willpower. You are no longer asking yourself to be strong in the middle of disorder. You are asking yourself to obey a decision already made in a quieter state. That is a different burden. It is lighter, cleaner, and more honest. The market will always try to pull you into fresh decisions at uncomfortable speeds. It will tempt you to improvise, and then reward that improvisation just often enough to make it seem useful. But the trader who lasts learns to arrive with fewer choices, clearer boundaries, and less need to invent meaning in motion. From there, the next question is how to build the kind of daily conduct that keeps those decisions from depending on mood. A trader's routine often grows too large because the ego wants to feel busy. More screens, more indicators, more opinions, more notes, more markets to watch. It can all look professional from the outside, but complexity is not the same as preparation. A routine that gives you too much to process may leave you informed, yet still unprepared to act with precision. Professional conduct in trading is usually quieter than people expect. It is the habit of doing a few necessary things the same way, day after day, whether yesterday was profitable or not. You review the main market condition. You identify the important areas. You check open exposure. You define what kind of opportunity is worth your attention. Then you stop adding noise. The purpose of routine is not to make you feel intelligent. It is to keep unnecessary decisions away from your capital. A large routine can become a hiding place. If you study too many markets, you can always find movement. If you follow too many opinions, you can always find someone who agrees with your bias. If you build too many conditions into your process, you can always explain after the fact why you acted. This creates the appearance of discipline while weakening the substance of it. A simple routine makes excuses harder because it shows clearly what mattered before the session began. The professional trader respects repetition because repetition exposes truth. When you prepare the same way, your results become easier to read. You can see whether your levels were useful, whether your focus was too broad, whether your best trades came from planned conditions or from distractions you allowed into the day. Without a repeatable routine, every session becomes a new experiment, and every mistake comes with too many possible causes. This is why your routine should be small enough to obey under ordinary pressure. If it requires unusual energy, perfect focus, or several uninterrupted hours, then it will fail when life becomes inconvenient. A good routine can survive a poor night's sleep, a slow market, or a busy morning. It does not depend on inspiration. It depends on structure. It tells you what must be checked, what can be ignored, and when preparation is complete. You must also understand the difference between reviewing and punishing yourself. A professional review is factual. It asks what was planned, what was done, and what should be corrected. It does not turn one bad decision into a speech against your character. The point is to reduce future error, not to perform regret. If review becomes emotional theater, you will avoid it when you need it most. If it remains simple and honest, it becomes one of the few tools that actually improves conduct over time. Restraint is part of the routine as well. The day should not begin with the assumption that a trade must be found. It should begin with the assumption that only certain conditions deserve involvement. That one change protects the trader from manufacturing activity. When the routine defines what is worth doing, inactivity no longer feels like neglect. It becomes part of the work. Keep your routine smaller than your ambition. Ambition always wants to add another market, another method, another source of conviction. But professional habits often subtract. They remove weak preparation, unnecessary opinions, unfocused scanning, and emotional review. What remains is a cleaner field of attention. And in that cleaner field, a trader can see whether the market has offered something that belongs to his plan. Over time, this kind of routine changes the way you approach the day. You do not arrive asking the market to entertain you. You arrive with a narrow set of duties: prepare, observe, record, and protect the quality of your decisions. But preparation alone is not enough. Once a position is opened, the question becomes whether you can let the trade speak without disturbing it too soon. After entry, many traders stop listening to the market and start listening to the position. The trade moves a little against them, and they feel threatened. It moves a little in their favor, and they feel protective. The same price action that looked ordinary from the outside suddenly becomes personal, because money is now attached to every movement. This is where trade management begins, not with prediction, but with the ability to judge behavior without letting the position speak louder than the market. A position must be allowed to prove itself. That does not mean you ignore danger. It means you understand the difference between normal movement and meaningful rejection. Every trade needs room to breathe inside the idea that created it. If you interfere with it at the first pause, the first pullback, or the first sign of discomfort, you are not managing the trade. You are managing your own unease through the trade. The market often tests a position before it rewards it. A good trade may hesitate. It may shake out weak hands. It may return to an area that still supports the original idea. If you treat every test as failure, you will repeatedly cut trades before they have had a fair chance to develop. The cost is not only the missed profit. The deeper cost is that you train yourself to distrust valid movement simply because it was uncomfortable. But the opposite mistake is just as costly. A trade that is failing will often give signs before the loss becomes obvious. Price may stop advancing where it should continue. It may accept levels it should reject. It may lose urgency in the very place where strength was needed. If you keep holding, because the stop has not been touched, or because the trade once looked promising, you are no longer reading evidence. You are waiting for permission to admit what the market has already begun to show. Trade management is the discipline of asking one question again and again. Is the position confirming the reason for being in it, or is it weakening that reason? This question keeps you away from two common forms of interference. One is cutting strength because it does not move perfectly. The other is protecting weakness because you do not want to be wrong. Both mistakes come from judging the trade by feeling instead of behavior. You must learn what confirmation looks like after entry. It may be continued acceptance in your favor. It may be strong responses at the right areas. It may be failure from the other side to regain control.